Hello and welcome to episode 456 of the Money to the Masses podcast with your resident expert as always, Damien Fay, and me, Andy Leakes. Damien, we're back. We had a week off last week, but we did have that special announcement.
We did, and just to reiterate to people, don't forget to support the podcast. Those of you who did go on to the website on the link moneytothemasses.com/podcast and found out all the ways that you can support the podcast going forward, then thank you very much, because we can see that on the traffic analytics that we have for the Money to the Masses site. So thank you. For those of you that haven't bookmarked it, please do make sure you go across to that page where you can find lots of different ways that you can support the show. And that includes things that are cashback offers, but also ways to compare the likes of car insurance, home insurance. I actually did car insurance this week, which is something of an eye-opener given the costs of car insurance at the moment and how much it's risen by. So make sure you do go across, look at that page, bookmark it, because not only can you save yourself money, but you can also support the show. But linking nicely to supporting the show, I just wanted to quickly read two reviews that we've had on the podcast in the last week. One of them is from RGSL, which said, "Love this podcast, really informative, great listen," with 5 stars. And the other review is from Timmy S84, which says, "My favourite podcast," and it says, "Your podcast is the highlight of my week and I love listening on a Sunday morning while walking the dog. Such useful information, and whilst not everything is always relevant to my personal situation, there is normally always something I can share with friends and family. Thanks for taking the time to produce such a quality show." So that is fantastic to get that back. That gives us a real boost. And linking nicely again to that, I just want to say hello to Ian, because I was walking from the school this week, so picking up one of my daughters from school, and I was stopped in the street by a chap called Ian who listens to the show. So Ian, you know who you are. He's a Kiwi, really nice guy. He said he listens to the show and he loves it. So that was really nice, actually, for that to happen while I was walking along the road, minding my own business.
Yeah, and before we get on with what's coming up on this week's show, just to mention, Dame, we never mentioned this actually, we work hard recording the show, but also after recording the show, we come up with a little 5-question multiple choice quiz that goes up on Instagram.
So on a Monday, we put out the quiz, and if you miss it on the Monday, you can find it via the highlight on the Instagram page of Money to the Masses. You'll see we always put it there, so people who listen to it later in the week can do the quiz. And this week, I actually put a quiz after Damien's market updates, the investment show that I do once a month. I put on a longer quiz. Normally the weekly quizzes have 5 questions, but I did a bumper 20 questions on the monthly show. Obviously, the answers are given on the page, so every page for the show, you can go through to that. You can see the quizzes on the actual page on the Money to the Masses website that we link to in the notes of any episode. So if there's an old episode that we've done this for, we started doing it this year, you'll find it on the link for the show on the Money to the Masses website.
Okay, so let's get on with what's coming up on this week's show. We've got 3 pieces.
So the first one links quite nicely to the market update. Now, I do understand and appreciate not everybody will listen to the market update, but at the close of that, I started to talk about gold, and in particular the movement or the rally in the price of gold that we've experienced of late. So it's almost been exponential, but the reasons behind the move are somewhat confusing because it isn't actually conforming to conventional thinking. And at the end of that show, I gave 5 possible reasons why the price of gold might be moving in the way it currently is, which is ever higher. But I wanted to delve into that a little bit more to explain a few of them, because I did rattle them off, and I think there are 1 or 2 people who are actually quite interested in me explaining a little bit more about the drivers. I'm also going to do a piece which links quite nicely to children, as I mentioned about the school pickup I did the other day. I had a conversation with my other daughter this week about investing, and she came home and caught me watching a bit of Bloomberg. I don't watch it that regularly, it's on in the background, and she started quizzing me about the idea of Bitcoin, and we got into investing. So I started to try and explain to her, and I thought afterwards it's a very interesting conversation that almost I should have recorded and put out onto YouTube, because obviously lots of people out there with teenagers who are starting to look at things and wondering what this investing lark is about and money and everything like that. So I gave her some key things to remember about money, really. So there's a little bit on investing, but mainly some key points. Just if you can bear those in mind. You should be all right in life. So I thought I'd bring those to the podcast. They are things we have covered before, but it's a nice summary. And the final piece, Andy, you're going to be doing...
I'm going to be talking about taxable benefits. Now, do stay awake for it. It is more interesting than it seems. So I'm going to be talking about taxable benefits, exactly how they're worked out and how you can check your tax code to ensure that you know exactly where you are with these. Because there are some quirks to taxable benefits, and something happened to me recently, which is why I'm bringing it to the pod this week.
Yeah, and more importantly, Andy says it happened to him recently. It's going to result in him getting a decent tax rebate. So that's how it came about when we were sitting there looking at this and going, I'm not sure many people actually realise that this is possible, and they could be falling foul of the same thing and inadvertently paying more tax than they should be and have been possibly for a number of years. So going on to the first piece of the podcast then, Andy, I'm going to jump straight into the gold piece. Now, gold has been rallying significantly. If you look at the price of gold on your stock app on your phone, if you're interested, you can look at the futures index of it. So if you go to your stock app and you put in GC equals F, that gives you a broad indicator of the price of gold, and you can see how much it's gone up in recent months. Now, from the lows of October, it's risen 30%, and the price of gold has risen almost 20% in the last 2 months. So that's an incredible rally. Now, just to give people some background on gold, here are a couple of shows I think are worth going and listening to. So there is podcast 120, where I talked about investing in gold broadly. There's podcast 144 when I talk about the truth about gold. Now, really what the outcome of that podcast is worth listening to, but it's that if you have gold in your portfolio, it doesn't actually reduce volatility. So some people think gold can be a good hedge against volatility in a portfolio. It's not. Actually, the more you have more than 5 to 10%, actually starts to increase the volatility in your portfolio. So that's worth a listen. We did a piece on Bitcoin versus gold, which was podcast 317, but things have changed a bit since then about the relationship between the two, which I'll touch upon very briefly in a second. And podcast 416, which is all about investing in gold and its outlook. And that was a podcast we did last year where we looked at what was going on with the price of gold. Well, things have gone completely crackers since then. So as I mentioned, I talked about the price of gold in the market update, and I gave a number of reasons trying to explain why it's behaving like it is. Now, traditionally, gold tends to do well if the dollar falls. So if the US dollar index, so that's an index that measures the price of gold against all other currencies pretty much in the world, a whole basket of them. And as it starts to fall, it tends to push gold up. Now, you don't have to fully understand the mechanics as to why, but that's what tends to happen. And what we're seeing now is the US dollar going upwards. So it's rallying, and that's been happening because the change in interest rate expectations. So the market is starting to predict that the US Federal Reserve, so that's the US equivalent of the Bank of England, is not going to be able to cut interest rates as much as they thought they would be able to, which means therefore that rates will stay higher in the US for longer, which pushes the currency up. So the dollar goes up against other currencies. Now, think of it in a very broad way. This isn't true, but if you think about a bank account that pays you better rates of interest, it would actually attract more money. So that isn't actually how it works, but if interest rates in an economy are going up, it tends to attract money. So the currency of that country will tend to go up. So in this case, we're talking about the US, but we have seen the US dollar going up and the price of gold going up at the same time, which is something that is very unusual. Now, in the past, I've talked about gold and what usually drives it. And one of the things is, like I say, the dollar, but also it's about fear. So if the market is fearful, so like now there's a geopolitical event, if there's war going on maybe, then investors will tend to go towards haven assets. They'll go after something like gold and they'll hold that. It may be there's a stock market crash. So that tends to be a driver behind the price of gold. But again, we've seen some of that, but it doesn't explain everything we've seen, especially in the last 2 months. Now, in that market update that I published just a couple of days ago, I mentioned that there were probably a number of reasons why gold could be going up, even though the dollar is going up. And it could be that people are buying it as a haven asset. So people tend to buy assets that have a store of value, and gold often is deemed to be a store of value. So people will rush to that in periods when there is geopolitical tension. So in the case of what's going on in the Middle East, people are worried about that. They'd rather hoard gold. So if you think about it, that if the whole world goes to complete chaos, then people will try to own stuff. And gold is one of those things that's a very limited supply of it, actually. And it's deemed to be one of those assets that can be a store of value. Now, oddly, we have had these political events been going on for some time, and that doesn't fully explain why the price of gold has risen so significantly. Now, another reason could be that there are people out there now worried about inflation coming back. So we have seen the inflation data in the US be stronger than people expected. So there is this second wave of inflation that's a possibility that I talked about on the podcast before and warned people there was a distinct possibility that this could happen based upon history. And it does now seem to be that could be playing out, and we've seen a spike in the price of oil, and that's obviously because of the problems in the Middle East. That will start to impact supply, and obviously supply and demand, that will therefore cause the price of oil to go up because there'll be a lack of supply, and demand is still obviously going to be there. Now, if the price of oil goes up, that causes the price of lots of other things to go up as well. So it's not just the petrol that you put in your car, it causes the things that are in the economy, things like plastics and everything. Price starts to go up, and that causes inflation. So gold has been deemed historically to be an inflation hedge. Now, if you look at the numbers, there is evidence that it's not that good a hedge against inflation, but hedge funds have been potentially buying it. That's one theory as to why the price of gold has been going up, in order to hedge against inflation. Now, again, I mentioned that limited supply idea. If you take all of the gold that's ever been mined, then it would actually fit in 3 Olympic-sized swimming pools, according to the numbers that have been crunched out there. So that seems quite an incredible stat. The point is, how true that is or not, there is a limited supply of gold out there, and that causes it to have that store of value, and that is often cited as one of the reasons why it can be an inflation hedge. So there is that idea as well. Now, the other thing is that when interest rates go up, gold is unattractive. So gold as a metal is not particularly useful. It's desirable, but it isn't used in that many things. So if you think about an economy, things like copper are used everywhere. You could even look in your house and can see copper being used. But gold is not an industrial metal that's used on a large scale. So therefore, often the thing that really drives the price of gold has been, as Warren Buffett would put it, maybe fear. So when you buy gold, according to him, that you are really hoping that at some point someone's more scared than you are right now in the future, so that you can sell it to them at a higher price. So because gold doesn't have that many uses and it doesn't produce a yield, there's no interest on it. If the rates in the economy are going up, which means therefore the rates on things like bonds or the rates you get in savings accounts are way more attractive as they go up, then people will be attracted to those types of assets or investments rather than gold. But of course, in a world where rates have gone up quite significantly, and there is potentially the talk that rates will be stuck higher for longer and even may have to go up a little bit again, then gold's been doing really well in that environment. And that's, again, unusual. You'd expect gold to be selling off. So there is this divergence again between what you'd expect or what logic says should happen in history to what's happening now. And the one thing that could be pointing to is that the world is expecting the US economy in particular to go into a recession, to have a sudden downturn, and actually predicting that rates are going to be cut quite aggressively in the US. So you've got this kind of almost perfect storm for gold, really. And when I say storm, I mean that in a positive way for its price, because there are people now worried about geopolitics, there are people worried about inflation, there are people worried about the fact that the US economy, even though it's doing very well at the moment, could actually crash. And that all means that it seems a perfect time to buy gold. But the other thing to bear in mind is that central banks have been buying gold, it seems, in a significant way. Now, the numbers are quite vague, but people are suggesting that they are. And one of the reasons that they might be doing that is because the US dollar could potentially be used as an economic weapon. And so this is one of the things that I said in that market update. There are probably less some people wondering what does that actually mean. And so the idea behind the US dollar being used as an economic weapon comes back to the fact that it's the reserve currency of the world. And so since 1944, the US dollar has been the primary reserve currency, and that means it's used by lots of other countries out there, and it means that it's maintained in large quantities by central banks out there and other financial institutions in order for them to make investments, transactions, or meet debt obligations that they might have, or to influence their own exchange rates. So it is also what most commodities are priced in. They're priced in dollars. And there was a really interesting video, and I think there was an associated book by Ray Dalio, who's a very famous and successful investor in the US, that talked about the idea of a reserve currency. And really, in simple terms, his idea was linked to the dominant superpower at the time. So if you go back in history, there's been various different superpowers or dominant forces in the world, including the UK when we had an empire, and ultimately the reserve currency of the world, so the thing that people mostly trade in and want, will be the one that's associated with that power. And that would have been the pound in the past. At the moment, as a result mostly of World War II, it's actually the US dollar. And so there's an argument now that the US dollar may be under threat in terms of being the reserve currency of the world, and it could actually start to be someone else, i.e. the Chinese yuan is one of the ones that people are pointing at. And it also does therefore mean in order to have a change, you typically have a world war, which is something not really to ponder too much. But the fact it is a reserve currency does give the US a sort of an unfair advantage in a way, because it means that they can use their own domestic currency to meet obligations. So there is not that currency issue that there is for other countries. And it also means that they can use it as an economic weapon. An example, if you go back to recent history, Donald Trump actually did this. He weaponized the dollar by scrapping the Iran nuclear agreement. And at the same time, he imposed a number of sanctions, which included restricting the use of the dollar by Iran. And of course, that therefore means that starts to exclude them from certain routes of finance. So that obviously has a huge impact. And it means that the US can use its own currency as a weapon against other countries, because you're essentially excluding them from financial markets. So that idea is that maybe countries out there are now starting to move away and want to hold other assets instead of the dollar in their reserves, and that includes gold. So it means that right now is a really interesting and fascinating time for holding gold. Now, I do actually hold gold in my own portfolio for 80-20 investor, and I have around about 5% in there, and that has obviously, as you know, it's jumped 20% in the last month. It's actually gone up, I think, since I've held it, about 50%. So gold is a very good diversifier in a portfolio, and at the moment, if you've got it, you're really enjoying some of the benefits. Now, one of the other reasons the price of gold could be going through the roof is actually algorithmic trading, which means effectively computer-based trading programs that just buy momentum. So as the price goes up, they're flying into it and buying more of it, which is driving the price ever higher. But that does mean it is susceptible to a pullback in some way. So the price of gold at the moment is incredibly fascinating. It does have that feel about it that almost it's going to keep going up, because we did have, for example, just a week ago, 8 days in a row where we had all-time highs on that particular asset. But obviously things like that can't go on forever. So we don't actually know what is really driving the price of gold. It could be any one of those things I've just mentioned or none of them at all. But it is fascinating to look at when an asset is doing something different, trying to work out why that is, because it is probably telling you something that could be applied to maybe other asset classes. So if it is that you really believe that the US economy is about to collapse, then that would actually start to suggest that things like treasuries will actually start to become attractive at some point, despite the fact that they're selling off quite aggressively at the moment. So I just want to finish this piece with a reference to Bitcoin. Now, Bitcoin, the price of that has been going through the roof. And obviously, as I mentioned, that seems to gain most people's attention. They don't even notice gold half the time. But Bitcoin has obviously been rallying, and it's for very different reasons. Because a few years ago, there was a point where gold and Bitcoin seemed to be doing things in sort of opposite directions, or there was some kind of relationship between the two. Less so now, because they have been going up at the same time. But the thing that's driving the price of Bitcoin is more than likely the fact that you can now buy it in ETFs in the US. So from the turn of this year, it was actually authorized. So people now in the US can gain exposure to movements in the price of Bitcoin via these spot ETFs, and it has been incredibly popular. In fact, I think the demand for that was underestimated, and that has propelled Bitcoin to new all-time highs. Now in the UK, you can't buy those yet. In fact, it doesn't seem like you're going to be able to buy it anytime soon. There are people in Europe who do offer exposure, but for UK investors, unfortunately, you can't gain it through ETFs at the moment. That's not to say it won't change, but it seems to be something that the regulators in this country particularly aren't keen on. So gold is once again proving to be that diversifier in a portfolio when equities and bonds are starting to take a turn lower. But as I've mentioned in those past podcasts, and there's links to them in the show notes, if you own gold, then it's best not to own too much, because at some point, if you own too much of it, actually it's a very volatile asset. It means its price goes up and down, just like you could see an individual share.
Okay, so let's move on to the next piece then. And this came about from you watching something on TV and getting caught and you were asked a few questions about exactly what it was you were watching. It sounds worse than it is.
It sounds way worse than what it actually was. It was far less sinister. I was working from home and my daughter came in from school and she wandered in and I had Bloomberg on the TV, and I don't often have Bloomberg on the TV, but it was a day where markets were all over the place and I was very intrigued what was going on and just to see what was panning out. And I just had it on in the background, and of course she came in and I don't think the sound was even on. And if you've ever seen Bloomberg on TV, it looks like Sky Sports, but all the things that would be all those tickers talking about, I don't know, the latest transfers or whatever it be on Sky Sports, that is all to do with finance and finance stories. So when you walk in, it looks a bit crazy. Well, of course, the first thing she saw that she recognised was Bitcoin, and she saw the price of Bitcoin was being shown on screen, and then started talking about what is Bitcoin, and we started having a conversation about Bitcoin. And inevitably, we then got onto the conversation about what it is, what is investing then, and how does it work. And so I started to give her the talk, as it were. And I actually laughed later in the day because I said to my wife, I actually had a talk with our eldest today. And she's thinking, what? Talk? And no, I wasn't talking about anything that was to do with growing up. It was about money. I'd always swore that I would actually one day sit down and try and teach them about money. And that was what we ended up kind of doing. And so I got into this idea and started to try and explain what investing is. Now, as somebody who's got lots of podcasts and has got lots of videos and website and all that kind of stuff, it's amazing obviously how much your children aren't interested in anything you do for a living, and they know that I talk about money, and I therefore had to try and engage her with this topic in a way that maybe a typical teenager finds interesting. And so this isn't going to be necessarily the best way. I'm all ears for people who've had similar conversations that have engaged their kids with money and things like that. I'm just going to throw out a few things that I just wanted her to look. If you do these, then you should be okay in life. So we started on the idea about what investing was, and I explained the idea. It's about obviously owning things and life, how you start off by earning money and you leave school, you get a job, you start to generate income, and at some point in your life, there comes a stage where you want to transition from generating income to actually accruing wealth, and that wealth eventually will look after you and generate income. So that kind of blew her mind in a way, because even though she's incredibly bright, the idea that this is kind of how life pans out if you ever want to give up working. And so we started to talk about that. Well, how do you accrue wealth? And of course, then we were referencing the idea of things like Bitcoin, which for a lot of people is just speculation. So we went back to the one thing I wish that people had drilled into me when I was at school, which was compound interest. And the idea of compounding is still one of the wonders of the world. And so what I did is I got the compound interest calculator that we've created at Money to the Masses. We'll put a link in the notes so people can play around with it. And what it does is it very simply just, you put in how much money you can a month, or we'll put a number in there, how long you're going to invest for, the kind of return that you might get, and then play around with it and see what numbers you get at the other end. And so I was explaining to her about, if you want to get wealthy, you have to build it over time. It's actually a slow process, but started to allow her to play with some numbers. So I started to say to her, look, get the calculator. Now, based on your age, would you like to be a millionaire? They all seem to be obsessed with being millionaires. I think that's the influence of TikTok and Instagram and all these things where they've been shown how to be rich and they're all shown a lifestyle. And so I was saying, do you like the idea of being a millionaire? How can we do it? So this is kind of a reverse engineered version of the podcast we did on how to be a millionaire. And I'll put a note in the show notes of this podcast because it was one of the most popular shows we ever did. So she started playing around with it, and she's now just decided, well, she has just become a qualified referee. She's really into football, and they can earn some half decent money actually for refereeing a game of football. And I said, look, if you were to put some of that money away each week, and we're going to put in a number that she decided, and how much do you think that would be when you're older? And she's picked an age. And so what she did is then start to play around with it and then work out the power of what compounding is. And then it becomes quite addictive, because what she started to do is work out very quickly how much things are. And well, if I want to retire early and have say £1 million, then I want that by the time I'm 38. I don't know why that number came from, but she decided, or age, she decided that was the time she was going to retire. We then got into the concept of the financial independence retire early principle, which was generated by her by asking, well, how can I do that? Because I don't want to work forever. So we then started to explain the concept of frugality and how you put money into your investments. She goes, well, can't I put in more than, I think she started off with £100. She started saying, if I did that, 50 it started off with, and then she worked out that wasn't going to get her anywhere. So she went to 100. But then she started to work out that actually, why can't I put in more than that? And I said, there's absolutely no reason. The only thing that limits you is how much you actually earn. So we started to explain the concept of, well, okay, I can't get to that £1,000,000. What are your options? And hers was obviously, well, can I increase the return? Well, you can take a bit more risk, or you put a bit more in, or you actually extend the time frame of investing. By doing it, essentially playing around with it and getting her to become a millionaire on the chart, on the table, she started to work out how much she'd have to put in, but then realised that the younger she did it, the better it would be. And it's like one of these things, when you show somebody how to do something versus telling them, then they start to grasp the concept. And of course, then her next idea was, well, I need to therefore get a half decent job then, don't I? Because if I can do that, then surely I'll put in more as my wage goes up. I said, exactly. So you're going to start putting more money in as your wage goes up. I said, so you can only do that if you earn more money. I said, but the problem you'll have is that you'll probably do what everybody does, and they'll have lifestyle creep. What's lifestyle creep? Right, that's where you start to earn a little bit more money, and then you decide that you're going to go on holiday with that extra money. You're not actually going to do anything with it. So then she kind of was liking this idea. Right, okay, so I could do that. Well, how do I know what I do then? And I said, well, there's lots of different versions of this stuff, but if you stick with the basic idea, you put at least 10% in, but ideally you aim for somewhere between 10 and 20% of your wage into savings and investments. You'll be doing very well in life. And of course, this then got into the idea, well, okay, so what do you do with the rest of it? So then we had the 50-30-20 principle. So we started to explain the needs, wants, and the saving, clearing debt aspect of the 50-30-20 principle, which for those of you who don't know, the idea is that it was a very rough rule of thumb, a bit like eat 5 a day, where you put 50% of your money into the stuff you have to, bills, for example, 30% into the things that you would want. So that might be something that is a bit more discretionary, and then 20% goes towards clearing debt or saving for your future. So we then started to work out, well, if you're going to put in this amount of money, then how much would you have to earn? And then these numbers, she started becoming engaged with the idea. So she said, right, if I'm going to be a millionaire by this age, and I'm going to put this amount in. So she said, well, why doesn't everyone do that then? And of course, we then got into the idea, well, because no one told me how to do that. When I was your age, no one sat down and told me this is what I had to do. And besides, you've got to have a parent who probably has to help you a little bit at this point. But there's nothing that just stops you starting to save money and get the idea going forward, even if you're putting it into piggy banks or whatever it might be. But of course, then we inevitably got into the idea of inflation, because I did highlight to her the fact that you do know that that money won't be worth £1,000,000, which then blew her mind. And I was like, well, there's this thing called inflation. So the way I helped her understand that was that if you want to buy the house we live in now, this is the price of the house now. If when you're 50, you want to buy the house that we live in now, you can't have the amount of money that it's worth today. You're going to need a bigger amount because the price of everything goes up. So I started to relate it to the things that she does actually buy in real life, which occasionally are things like clothes and also sweets. The price of things have gone up. She then got the concept of what inflation is and how to relate things to today's money. So when you let someone play with a calculator, actually, the idea that really seemed to grasp her was that she could dictate how much she'd end up with. I explained the idea that things don't go up in one direction, and obviously your money does fall over time if you, like, at times if you invest, but over the long term it does go up. And it's actually one of the reasons Warren Buffett is so successful. He's been investing basically for 80 something years. But the one thing that did engage her, which is kind of a tricky one as a parent, is I said to her that in theory, if you did this and you took on the mantle when you got to 18, because she was like, well, how am I going to do it now? And then I sort of told her that I'm actually doing a little bit of this for her already, because obviously we run the Money to Masses podcast, so we do actually do what we preach, although we don't preach such, but we do live it. And so I was like, this is the mantle you have to take over. This is the baton that you have to run with. And I said, in theory, it does free you from the burden of having to have to do a job just because it pays you a wage that is something half decent. I said, you aren't having to chase money. You could, in theory, if you do this and you start young, you can just chase a dream and actually do something that you want to do rather than something you have to do. I do like that idea. I do think being able to give people the freedom in their life to do a little bit more than just having to do jobs that they hate just because they pay the bills. But at the same time, she did grasp the idea, the more she earned, the more she could put in. And so the final thing I was really pointing out to her is, like, she goes, well, you got that pot of money. She thought that was it. She thought once you got that pot of money, that was the job done. You had to live off that. And I was like, yeah, you do, but you can't just take all of it if you want to be able to survive. So what you end up doing is you're going to have to take the 4%. So I then explain what the 4% rule is, which effectively, for those who don't know, is the idea that sustainably you can withdraw something like 4% from a pot of money over the long term and not run out of money. And it's actually over about 30 years, but you won't realistically run out of money if you keep your withdrawals to less than 4% a year. Actually, you need to do a little bit lower than that, probably nearer 3 if you really don't want it to run out. And so therefore I started to get her to reverse engineer the numbers very quickly for how much you want to live on today. What sort of pot of money would you need? Now, factor in inflation. And basically, with a very simple calculator, you can get your kids to understand the idea of why you would want to put money away. And so she got engaged with it. And so I'm not saying this will work for everybody. And the proof is in the pudding, because she then did soon go off and do whatever else she was doing, and homework and stuff. And so she probably very quickly forgot about it. But this is stage one. This is the first brick that I'm trying to put into that wall to get her to understand how money works, to empower her in the future to be able to do something, to empower her in the future to be able to have choices that perhaps most of us didn't, because our parents never taught us this kind of stuff. And also then touched upon the idea that, debt. The problem if you get debt young, and that can start to take away from the 20% you put towards your savings and investments. So it was a strange conversation I didn't expect to have, but it was one that was quite insightful to actually get an idea of what people who are teenagers really understand about money and the value of it, and how much you have to have in order to have the retirement or lifestyle you want. Very quickly, the FIRE movement, even though she didn't know what it was called, came to her mind, the idea that she didn't want to work forever, which I think is valid, but she obviously had to then understand the idea about frugality. The one thing that I think that she learned, which I want her to take away, was that she has something that I don't. And she has something that you don't, Andy, and she probably has something that lots of people listening to this podcast don't, that will work in her favour, and that's time. There's one thing in money that will help you, it's time. If you can make everything you do with money a function of that, then you will ultimately be successful. Whether it's a career where you start to decide, I'm going to take so many exams, so therefore after a period of time you've passed a set of exams, and therefore people can't take those qualifications away, you'll probably end up getting very decent pay rises or jobs. Or whether it's compounding, taking advantage of it by investing over the long term, starting early, be small amounts, and the whole snowball effect. I think trying to teach people the power of time is incredibly important, and I hope if that's the only thing she took away from it, then maybe I might have done a half decent job. Okay, so moving on to the final piece of the podcast, Andy, we've done investing, I've just covered a whole range of topics there, and now we're moving on to tax.
Yeah, it doesn't sound very sexy, but it is interesting, I promise you. So we're going to be talking about taxable benefits in kind. And I'm sure you all know, but a taxable benefit is essentially just a reward for services by an employee, which is given in a form other than cash. It's usually referred to, as I said before, as a benefit in kind, and it could be a benefit that's provided by the employer itself or by a third party. So what are we talking about here? We're talking about things like a company car. It might be mileage allowance that you get over and above the HMRC approved rates. It might be a company van that you have that you can use for personal use. But it could also be things like accommodation, professional or private memberships or subscriptions. And the one that is most commonly associated with a taxable benefit in kind is private medical insurance, PMI, or as most people call it, health insurance. So while the benefit is provided to you by your employer, you are still required to pay the tax on the value of that benefit. Now, the tax on those benefits can be worked out in one of two ways, and it's generally down to the employer as to which method they choose. There is the P11D method, P11D method, or there is also the payrolling method. And I'll briefly explain what each of those methods mean, because the way that they're worked out is slightly different. So the P11D method is the one that's most commonly used. Essentially, if you're in receipt of taxable benefits, your employer will give you this P11D form at the end of the tax year, and by the 6th of July each year. So for example, if we're looking at the 2023-24 tax year, the most recent one that's just gone, you should be handed by your employer a P11D by the 6th of July. That's the deadline for that. And it summarises the type and value of any benefits that you've been provided and the amount that that benefit represents. And essentially it's taxable in the same way as your employment income. And what will also happen at the same time that you get a copy of that form is your employer will send that form off to HMRC. Now, once HMRC receive that form, they'll proceed to collect the tax due on all your P11D taxable benefits, and they do that by amending your tax code going forward to include the value of the taxable benefits that you've already received the previous year. So the tax code adjustment will mean that more tax is collected going forward. So in effect, you're paying for the benefits you've had in arrears. And actually, this is where the system falls down slightly in some cases, which we'll come back to in a second. So that's the P11D method. A form is given to you and submitted to HMRC detailing the benefits that you've had, and then your tax code is adjusted and you'll subsequently pay more tax the following year. Or there is something called the payrolling method, which is becoming more popular. And ultimately, this is where your benefits for the year are worked out ahead of time. So when the new tax year rolls forward, your employer will say, well, you get these benefits, and they'll submit to HMRC the benefits that you're going to get for that year coming up, and then it's applied in real time each month going forward. So you're effectively being taxed in real time each month as you go forward. Now, why this is important and why I'm bringing this sort of technical nonsense to you in the pod is that the P11D method that I mentioned earlier is the most popular method, but it isn't the most efficient method. And there are times when it causes issues, specifically for those people who move jobs. Now, I'm not going to get into it, but there's a certain regulation that dictates that when you move employers, they do not have to send out to you a P11D. So you'll know that when you move jobs, you get something called a P45, and that will summarise what you've earned in that tax year up to that point. And you can give that to your new employers, and also that can be sent to HMRC, and they can marry the figures when you move over to your new job. But crucially, they're not required to send you or give you a P11D either then or at the tax year end. So if you are someone who's moved jobs and you've received taxable benefits under your previous employment, then it is entirely possible that HMRC will receive a P11D form at some point, ultimately therefore adjusting your tax code for the following tax year, even though you're at your new employer. Now that's fine in essence because you've already received that benefit, so quite rightly you should still pay the tax on that in the year going forward, even if you don't get that benefit with a new employer. Stick with me. Where it does become a problem, however, is the following tax year, particularly if your new employer that you've moved to doesn't provide any taxable benefits, or those taxable benefits that you receive through your new employer are significantly different. So to give you an example, at a previous employer, I received a private medical insurance as a taxable benefit in kind, and it was worth about £1,000 a year in terms of real value, and it was reported on my P11D annually, and I was required therefore to pay the tax on that £1,000 benefit. It was a benefit in kind. So what would happen is HMRC would receive that detail at the end of the tax year, adjust my tax code going forward, and I would pay the tax due. When I moved jobs, I fully expected my tax code to still adjust for the following tax year, and that was absolutely fine because I knew that I had a taxable benefit at my previous job, and I just assumed, as you would, that HMRC would ultimately remove that adjustment going forward for the following tax years because obviously that benefit no longer existed in my new job. Well, having spoken to HMRC, I can confirm that in situations where they've regularly received a P11D form for an individual that details taxable benefits, unless they are explicitly advised that those benefits are no longer in place at the new employer, they will make the assumption that those benefits remain, as I said, even if you've moved to your new employer and those benefits don't exist anymore. So I've since found out, having unwound this and spoken to HMRC, that the tax code adjustment has been going through for every tax year subsequently for my existing employer, Money to the Masses, for each of the last 5 years, and I've paid a significant amount of tax for a benefit that I simply don't have. Now, some listeners might be thinking, well, surely you can see your tax code on your payslip or on your P60, surely you should have noticed, but it isn't that simple because there are a number of reasons why someone wouldn't have the standard tax code. Now, the standard tax code is 1257L, and that ultimately means that you get a personal allowance of 12,570. And now not everyone will have that code because there are a number of reasons why it might be different. They might have a second income, they might be in receipt of certain benefits. And in my case, I actually have a marriage allowance added on to my personal allowance because I take some of my wife's benefits. She doesn't earn as much. So my tax code is always slightly different, so it didn't ring any alarm bells. So this is just a piece to remind people to check their tax codes and make sure that everything is as it should be, especially if you've moved jobs. Now, I've provided 2 links in the show notes. One is a link to HMRC that lets you check your tax code for the current tax year, and there's another link where you can check your tax code for previous tax years. There are 2 different links there. Just a word of warning for those checking their tax code for the most recent one just gone, HMRC does say that it's taken taking a little while for them to actually finalise the numbers for the 23-24 tax year. So there might be a note on the system that says, we're still finalising the figures, please check back soon. That's perfectly normal. The tax year is only just finished, and maybe give them a couple of weeks on that. So click on those links. You'll need to sign into your personal tax account using your government gateway user ID and password. And if you don't already have one, you can easily create one when you sign in for the first time. And this is where the system has actually really improved. It's much easier than it ever used to be. There was a very archaic system where you had to go online, request something that would then be sent to you in the post, and then you had to sort of type that number in and then create a new password. It was a nightmare. But now it's really, really simple. You can do it all in the same login process. You'll need your national insurance number, your postcode, and 2 other forms of identification like a passport and driving license, and you should be able to log in just a few minutes. And just a final reminder, what we're talking about here is PAYE benefits. The links that I've provided and the details about the government gateway ID are for people who pay tax via PAYE, and it's not possible to use that service if self-assessment is the sole way that you pay income tax. If you pay an element of both, you can still use that system. But if self-assessment is the sole way that you do it, you need to do it via your normal self-assessment route. But the likelihood is you'll be used to doing that anyway.
Can I just say, Andy, I think you've explained that really well, because tax isn't the advert taxing, but you've managed to explain that. And the real takeaway, therefore, is for people is make sure you do check your tax code. And even if you think it looks roughly right because you're expecting a deduction like Andy was, then it's worth checking how the number's been arrived at when it comes to your personal allowance, because it could be that you end up being owed a tax rebate.
Yeah, and those tax rebates can be significant. I don't mind saying that it's a few £100s because this has been going on for several years for me. And don't be put off by doing this, because the first initial stage is going online and checking. And then if you realise there's a discrepancy, the best thing to get it resolved really is to then give them a call. And I'll put details of phone number again in the show notes. But you might have to sit on the phone and wait for a little while, grab a sandwich, do it on your lunch break. Within 20 minutes, half an hour, you'll probably get through. It's a free phone number. But the people you speak to there, they are tax experts. They do know what's going on. They can resolve your query relatively quickly, or they should be able to. So while I wasn't looking forward to giving them a call because I knew it was going to take a while to get through, once I got through, the person I spoke to was really, really knowledgeable, and they sorted out my query in less than 10 minutes. So
well I have to say, Andy, I'll give you the true story. Andy was positively jovial. He did it in the office, maybe because he knew he had a rebate coming his way, but he seemed like he was enjoying the conversation with the tax people. So it obviously isn't that bad at all. So for anybody out there, it is worth doing it. Any questions, do go to your payroll as well, because they should be able to help you, because that was one of the ways that we were able to unpick all of this stuff with Andy, was what was going on, is because the payroll people at your work, because if you're getting paid, obviously paying tax via PAYE, it's like you're employed, and so therefore they should be able to help you with any questions. But ultimately you will end up talking to HMRC and they'll be able to put it right. And like Andy said, it won't probably be as painful as you think once you get through the queuing.
So that's it. We are done for this week. And yes, I did get excited on that call, Damien, because I've got some money coming my way, and hopefully this piece has helped someone out there and maybe even get that tax rebate that they're due.
That is a good point, because there could be somebody out there who, for example, has somebody they've known for 20 years who they run a podcast with that they might actually like to buy a pint with the money they've just found. Anyway, that is it for this week on the podcast. As ever, do review the show. Do please support the podcast. You know that page, moneytothemasses.com/podcast. There is a link in the notes. Don't forget, there's always a page for every show we do on the Money to the Masses website. There will be the quiz on there, the 5 questions, so you can go and check that out. Also follow us on Instagram and YouTube, all the social channels. YouTube in particular, we're putting out more and more stuff on YouTube all the time. And also don't forget to join our Facebook group, facebook.com/groups/money to the masses. So Andy, I think all that's left for us to do now is to say until next time.
Until next time.